Hello everyone and welcome to MBA 605 Auditing. Today's topic is Audit Planning and Analytical Procedures. What we're going to set out to explore is the importance of why adequate audit planning is essential. And this is a very important step that occurs very early on in the audit, and it's absolutely critical to the audit process that this is done thoroughly and we don't take shortcuts with respect to this. We want to understand what the importance is of the client acceptance decision and how that helps to inform the initial audit planning. We want to understand the importance of why we need to understand the client's business and industry. And then as a result of this understanding, we want to be able to make an informed decision about the client business risk. And so we'll talk a little bit about, well, what is business risk? We want to talk about preliminary analytical procedures, and from an audit standpoint, this idea of analytical procedures, these are required procedures at the planning phase, so we cannot get away from performing these procedures. We want to state the purposes of the analytical procedures and explore the timing of some of these purposes. And then we want to select the most appropriate analytical procedure from among the 5 major types. And then we'll talk about computing some common financial ratios, which are a form of these analytical procedures. So there are really 3 main reasons for planning. One is to obtain sufficient appropriate evidence for the circumstances. Obtaining sufficient appropriate evidence is essential if the CPA is to minimize legal liability and maintain a good reputation in the business community. So we need to make sure we can get appropriate evidence and sufficient evidence to perform our review and to reach some conclusion. We also plan to help keep audit costs reasonable, and that is so that we remain competitive and so that we can offer a good value to our clients. And then we want to avoid misunderstandings with the client, and this becomes important because we gain a lot of leverage by auditing the same client year in and year out to the extent we're able to and in accordance with the regulations. And we want to maintain a good relationship with them because we want them to trust us and we want to be able to trust them. And that's what the makings of a good audit are. And so by planning adequately, by ensuring as much as possible that there are no surprises during the course of the audit, then these become some of the objectives of these planning exercises. And so now we have to move into a discussion on some risk terms. When we talk about acceptable audit risk, we're really talking about a measure of how willing the auditor is to accept that the financial statements may be materially misstated after the audit is completed and an unqualified opinion has been issued. And so another way to think about that is acceptable audit risk really refers to our level of comfort with having said that the financial statements are okay, they present fairly the results of transactions when really they don't. Then we talk about this idea of inherent risk. And inherent risk is a measure of the auditor's assessment of the likelihood that there are material misstatements in account balance before considering the effectiveness of internal controls. For example, if the auditor concludes that there is a high likelihood of material misstatements in accounts receivable due to changing economic conditions, the auditor concludes that inherent risk for accounts receivable is high. We can also look at this to think that inherent risks are if a client operates in a very high dynamic, a fast-moving environment, one that may have been plagued by fraud from competitors to suggest that perhaps it's more rampant through an industry than another, through one industry than another, well, then this may point to a higher inherent risk associated with that client. The importance of this idea of acceptable audit risk and inherent risk is that it's part of the audit planning because it helps determine the amount of evidence that will be needed to accumulate and the experience level of staff assigned to the engagement. And so that's why in our audit planning, we have to determine these levels of acceptable audit risk and inherent risk. During the initial audit planning, we really have to involve 4 decisions, which should be done early on. So we have to decide whether to accept a new client or to continue servicing an existing client. And this determination is typically made by an experienced auditor who is in a position to make important decisions, and it's not generally one delegated to junior level staff. We have to identify why the client wants or needs an audit, which may affect the remaining parts of the planning process. To avoid misunderstandings, we want to obtain an understanding with the client about the terms of the engagement. So it's important to say up front and to agree up front about what's important with respect to how this audit is going to be conducted. And then based on this, we want to develop an overall strategy for the audit, including who are going to be the auditors that perform the audit. Do we require any audit specialists? Are there any conflicts of interest that might preclude using some auditors or above different auditors? And so a lot of effort goes into this initial audit planning, as you can tell. And so when we talk about client acceptance and continuance, if this is a new client, we want to talk to the predecessor auditor, although we need the client permission and or the client's permission. And we want to understand if the predecessor auditor had any issues, why did the client move from the predecessor auditor to a new auditor, and we just want to gather some background information. If they're continuing clients, we really want to do annual evaluations about whether to continue the audit based on any issues that came up in the last audit, any unpaid fees, were there fee debates, were there issues that the client refused to pay fees for certain reasons, and then some overall assessment of the client integrity. And we have a lot of insight into that from having previously audited them. And so when we move on in our planning phase to this identification of reasons for the audit, we are really looking at 2 factors, and that is who are the likely statement users and what are the intended uses of the statements. And so this will help us tremendously in establishing the scope and in planning out the audit. For instance, we're likely to accumulate more evidence for companies that are publicly held, that may have extreme indebtedness, or that are likely to be sold, simply because we can infer from those situations that a lot of importance is going to be placed on the financial statements, subjecting us as their auditors to a significant level of legal liability. Then we move on to this critical step that is obtaining an understanding with the client. And we do this through engagement letters where we describe the audit objectives. We clearly delineate the responsibilities of the auditors and management, and we clearly establish what the schedules for the audits are, or the schedules for the audit is, and then what the fees are. And in this engagement letter, we inform the client that as auditors, we cannot guarantee all acts of fraud will be discovered. It's, again, unless this is a fraud audit, the overriding purpose of the financial statement audit is not to detect fraud, but it is to come to some sort of an opinion regarding the financial statements. Obviously, if fraud surfaces during the audit, it has to be addressed and handled, and we'll get to that later on about how that happens. And so, having performed all of those steps during the planning phase, we move into developing our overall audit strategy. And so this audit strategy should include consideration of the client's business and industry, any material misstatement risk areas. These are complex transactions where there are subjective estimates that are involved that may be difficult to understand, that may just make them inherently risky from a user standpoint. We look at the number of client locations. Are they in a foreign country? Do we have access to those operations, or do we have to rely on the work of other auditors? And then we want to look at past effectiveness of the controls in place. This preliminary strategy helps us to determine the resource requirements and staffing. So that is, can we use the auditors that have been, if this is a continuing audit, who performed the audit in the prior years? Are there situations in the client business base that requires that we bring in specialists that we just don't have the in-house expertise to? But all of these are decisions and considerations that come into play very early on in the audit during this planning and strategy development phase. And then this slide is just meant to help us clarify the importance of and the reasons for obtaining an understanding of the client's industry and environment, external environment. And these are because of the risk associated with specific industries. So if we're auditing someone who's in the nuclear industry, that's a very risky industry. We may have to rely very heavily on external specialist assessment of certain risk characterizations. There are inherent risks common to all clients in certain industries, and there are unique accounting requirements that as professionals and as auditors we need to be aware of, because these accounting requirements are what we're going to be using as our criteria to determine the fair statement of financial results. We talk about the importance that the auditor places on understanding the business operations and processes. And so we need to have a good understanding of the major sources of revenue. Who are the client's key customers and suppliers? And are there risks associated with either of those groups? What are the client's sources of financing? So are they equity financed? Are they debt financed? And if they are, then what are some of any unique terms and conditions around those financing sources that make up their capital structure? And then we want to understand any information about related parties or related party transactions and what implications that may have for our financial statement disclosures. We obviously, to the extent possible, want to tour the physical facilities, which will enable us to assess asset safeguards and help us to visually interpret accounting data as it relates to assets. It's also very interesting. It provides the auditor with a lot of insight. And after auditors have been in multiple different clients' facilities within the same industry, they're able to spot weaknesses more easily by these plant tours. So wherever we can do that, we should take advantage of that opportunity. And then again, we talk about wanting to identify related party transactions, and these are transactions involving either affiliated companies, so subsidiary transactions between wholly owned subsidiaries of the same company, transactions between principal owners of the client, any other party with which the client deals with, or transactions with parties who can influence management or client policies. It's important as we assess the integrity with respect to a client that we understand what the client's code of ethics is, and we should look for a code of ethics, and we should look to see that that code of ethics applies to all levels of management. We also note here that the SEC and Sarbanes-Oxley require companies to disclose amendments and waivers to the code of ethics. So this is an important part of the management of companies, and we should, as auditors, we should be alert to and ensure that a sufficient code of ethics is in place. If it isn't, it tells us something about, perhaps it tells us something about the integrity of management. And so then we get to this idea of preliminary analytical procedures. And these are really just comparisons of client ratios to industry or competitors' benchmarks that provide an indication of the company's performance. So it helps us to focus our audit where we may have results of these ratios or these analytical procedures that are different than what we would have expected the results to be. They may help to reveal unusual or high-risk areas. And they can also help us to understand and look at trends in performance as a result of these ratios, and again, help us to focus our audit efforts. Analytical procedures may be performed at any of the three times during an engagement, but we also have to remember that the standards require that we perform them in the planning phase, and that's intended to help us see any potential area or problem areas that we might want to focus our audit efforts on. They're often done during the testing phase to help inform the results of other substantive testing actions, and it's also required during the completion phase, which we'll talk to later when we get into talking about completing the audit. And so this figure helps us visualize the timing and purposes of these analytical procedures. And so we can see that where the purpose is to understand the client's business and industry, it's clearly required at the planning phase. And that's when it becomes most valuable, because that's when we're trying to develop a baseline understanding of the client. It's required with regard to assessing the company's going concern. It's required during the planning phase and the completion phase. It's also required during planning phase where the goal of them is to indicate possible misstatements, and so it's during this planning phase that it might help us focus our efforts. It's secondarily with respect to possible misstatements during the testing phase, and again, that's to help inform the results of our testing. And it's also required at the completion phase, again, to confirm and help point to risk for possible misstatements. And then again, during the planning phase, the secondary purpose of it in the planning phase would be to reduce detailed tests. So if we have very favorable results from analytical procedures during our planning phase, we may reduce the amount of testing we perform on certain transactions. Or if we apply analytical procedures during the testing phase of the audit, there again, it may at that time help us to reduce the detailed test and cut down on some of the cost of the audit. And then we look at some of the common financial ratios, and I'm sure you all have discussed these in other finance classes, but we look at liquidity ratios, which give us insights into the short-term debt-paying ability of the company. We look at liquidity activity ratios that speak to how well management is managing current assets. We look to ratios to help us determine a firm's ability to meet long-term debt obligations, and we look to profitability ratios to help understand trends in a company's profitability, or perhaps trends in other areas that impact profitability. For example, the gross profit margin. So is it trending up? Is it trending down? And so just to quickly summarize the results of analytical procedures, we say we perform those to compare ratios of recorded amounts to our expectations. Where our expectations are not met, we perform additional audit steps. We use them in planning to understand the client's industry and the client's business, and then we use them throughout the audit to help identify possible misstatements, to perhaps reduce the detailed tests that are required. And again, if the analytical procedures don't meet our expectations and there's no explanation for that, we may have to increase the detailed tests that are required. And then we use analytical procedures to help us assess the going concern issue, which we'll speak to later, but that's a step where we have to assure ourselves, convince ourselves that a company has the ability to stay in business for the next year.